Is hysterical market speculation pushing us toward another crash? Despite COVID, global stocks begin to rise to 2021, but some analysts warn of an epic bubble amid fears that the flow of stimuli is creating a monster. Riots are not usually viewed by investors as a buy signal. Yet, even as the rebels stormed the seat of the United States legislative government last week, the stock market indices reached new highs in New York, adding another chapter to the apparent opposition that has persisted for 12 months of an economic gravity. As measured by the benchmark S&P 500, Wall Street was not alone as it kicked off 2021 with a bang. With investors ready and able to spend money, President Joe Biden made a jump of over 6% in the FTSE 100 in London in the first week of the year in hopes that cheap borrowing costs and vaccines will end coronavirus lockdowns. Yet amidst the euphoria, serious concern arises. Are we on the verge of another colossal accident? Some experienced traders believe this. The British co-founder of United States investment firm GMO, Jeremy Grantham, took a break from some of his investors last week when he described a truly epic bubble that resulted from the recovery from the 2008 and 9 financial crisis. I believe this event will be recorded as one of the biggest bubbles in financial history, with overvaluation, explosive price spikes, insane issues, and hysterically speculative investor behavior, he wrote in a letter to investors. Analysts at Bank of America joined him last Friday, warning of sparkling prices, greedy positioning, and telling clients to sell stocks. There is a growing divide in the investment world. On the one hand, there are those who believe that recovery from the epidemic will give stock markets extra momentum. On the other hand, there are those who think the bubbles inflate to the point of explosion. In some parts of the financial markets, there are relatively few investors who do not acknowledge the existence of speculative bubbles. The craze for Bitcoin, the cryptocurrency, seemed to dissipate in December 2017 when prices dropped from under $20,000 in 2019 to just under $4,000 and hit peaks near $42,000 last Friday. Other contenders for balloon status are electric car pioneer rivals such as Nikola and Chinese NIO, whose shares have gained value as investors scramble to take on gold rush claims in the Green Pass and Tesla. The tenfold dramatic increase in Tesla's market value since the beginning of 2020 made CEO Elon Musk the richest person in the world last week. The automaker is worth more than the next 7 most valuable ex-automakers combined, although it reaps some of its profits. Still, Bitcoin and Tesla were by no means the only beneficiaries. While for most of us, 2020 was remembered as a year in which we were limited to our homes, for the financial markets, it was a year when prices escaped restrictions. Paul Tudor Jones, a billionaire hedge fund manager, pointed out last month that more companies' earnings were priced 100 times more than at any point in history, and were priced nearly 50% more than the dot-com bubble of the early 2000s. Guy Munson, Chief Investment Officer at Saracen & Partners, a London-based investment firm, said in 2020 that it was marked by nearly universal asset price inflation, a direct result of central banks injecting trillions of dollars into the economy, a process known as quantitative expansion. Munson said the virus effectively caused an unmistakable setback, which means there is little political pressure from the government and central banks to rescue operations. Unlike bankers who grew too big in the banking crisis of 2008 and 9, it was difficult to blame bar owners or hairdressers for a government order to close their shop. Munson added that central bank asset purchases under QE were nearly 3 times the financial crisis at the height of the pandemic. The key question that keeps investors awake at night is whether their counterparts like Federal Reserve Governor Jerome Powell and ECB's Christine Lagarde or Bank of England's Andrew Bailey will raise interest rates to anything similar to pre-2008 levels. Even a hint that the Fed might try to reduce the flow of incentives was enough to put pressure on markets in the past, especially during the shrinking tantrum of 2013. The bounce in borrowing costs was enough to convince central bankers that support will be lifted, causing painful stock market dips. Some argue that, by certain metrics, market valuations are not exactly overinflated. According to Kiran Ganesh, the multi-wealth strategist of UBS Global Wealth, the S&P 500 is worth about 22 times the estimated earnings for 2021, about 16 times higher than the long-term average, but lower than the 30 hits before the dot-com bubble burst. This is a risky environment, he said, pointing to circular companies struggling in the early stages of the pandemic, such as large industrial manufacturers, banks, and utilities companies. However, he warned against the FOMO, which fueled the fear of kidnapping, attracting people to companies that had already seen their value. Ganesh added that there is a little indication that central banks have the will or the ability to provide the conditions necessary for the continuation of stock market gains by raising interest rates and bond yields above historically low levels, moving against prices. He added that UK companies have certain opportunities to catch up with the United States, partly due to a Brexit deal that reduces uncertainty at the expense of raising other trade barriers. But others believe that central bankers afford to curb financial collapse are hiding problems for the future, and already low interest rates mean that there is little room for maneuver if inflation rises, or perhaps more likely, growth does not meet investors' great expectations. Sven Henrik, founder of market analyst Northman Trader, said that prior to the pandemic central banks had already expanded too much. Central bankers knew that their policies were already fueling a stock market bubble, with the side effects of fueling inequality between wealthy shareholders and those who could not participate in the stock boom. But he said that their inability to back off without causing panic will cause problems if they lose control. My concern is that they create a huge asset bubble and price distortion, said Henrik. They created this beast that they must continue to feed on. If you make any investment or legal decision, it is advised to consult an expert before making this decision.